3, 2, 1.
That's right, folks. This is On the Money with Ryan Wheelis, financial advisor, putting together your financial flight plan for retirement. So many things we're going to be talking about on today's hour-long radio program here. If you're also joining us on the YouTube channel, that's why I'm always introducing this guy. We do a full hour-long radio program every single week. Mr. Ryan Wheelis, great to see you. How you doing, buddy?
I'm doing great, man. It's been a great week here at the shop, Spike, but folks, get your year-end planning done now, okay? Folks
Yes,
are calling
please.
this up every year, and I wish I'd have done that last year. I wish I'd have done that last year. Any year-end tax planning stuff you want to do, you've got to do it now before the clock strikes midnight on December 31st of this year, or you miss the boat. Don't be that person who goes to the accountant and finds out that you could have done all these things but didn't do them in time.
I want to talk about how we build retirement income portfolios, but I think that's going to come later in our video. Some of those year-end tax things we need to think about, that can include charitable giving, gift giving. You know, if we want that on the books, it's got to happen before the end of the year, right? This isn't the stuff that can float over until April 15th.
Yeah, Spike, there's a lot of stuff that you can do, to mitigate tax liability. Folks, listen, I love this country. It is the best country in the world by a mile. I don't have a problem paying my taxes at all, okay? I don't want to pay more than my fair share of taxes, though. And a lot of us have the ability to be in kind of the same boat. But if you don't take time to do it, you are in a situation to where you lose it, okay? And what I mean by this is, for instance, let's just look at something, I don't know, like 401k contributions, okay? You may be in a situation to where you got a pay raise this year, but you didn't increase your payroll deduction come out of your 401k or your 401k contribution. Well, if you don't do that, you're going to pay more taxes today than you will in the future because you could have put more in the 401k and got a tax deduction. That's just one example, Spike. Another one is looking at funding an HSA. If you fund an HSA this year, health savings account, all right, you have the ability to deduct a substantial amount of money this year over and above and beyond a retirement account. But if you don't do it in this calendar year, you miss the boat to do it for this year. And where I'm going with this, Spike, is I can't count the number of times that I hear clients going, Ryan, I went to my accountant. I was either expecting a bigger refund or not to have to pay any money. I got a smaller refund and had to pay money. And then I asked my accountant, what are some things I can do? And the accountant says, well, you could have done this. You could have done that. You could have done this. You could have done that. So you miss the boat. And what happens is you go through the year, and a lot of us don't take the opportunity to do those things in the current tax year, and we wait again. And we get on the cycle of, man, I wish I would have done those things. And that's where I'm really just trying to help the folks, that are listening to the show and on the podcast and on the YouTube channel here, is let's break that cycle. Let's understand what our opportunities are before the opportunities pass us by to mitigate our tax liability. All right.
Right.
So another, there's a lot more to it, Spike. For my higher net worth clients, now, I bet if you look at your portfolio and your non-qualified after-tax accounts, I bet you have winners. I know you do because the market's been going gangbusters, but not all areas of the market have been hot. So I bet you also have some losers, all right? So what you should be doing right now is taking advantage of tax loss harvesting, where you sell your losers against your winners. So if you've got a negative $15,000 loser, sell it, and then sell $15,000 worth of capital gains, okay? You harvest your capital gains because the $15,000 gain is wiped out by the $15,000 loss, okay? And then you buy the stocks back in 30 days into the new year. That's to avoid something called a wash-sell rule, but that is how you do tax loss harvesting. That is a great way to mitigate tax liability, all right? Another one, Spike, I just did this myself. Pay your property taxes. If you've had a big year, go ahead and pay your property taxes this year. Don't wait till next year. Pay them both in the same year. You can do that. Look at your withholding on your paycheck. Have you withheld too much? Have you withheld too little? Right? I think there's a misnomer out there for folks is, they get really excited about tax time because they get this massive tax refund.
Yeah.
Folks, if you're getting a massive tax refund, all you're doing is loaning the government your money interest-free for a year. Well, Spike, when money market accounts are paying squat, that wasn't as big of a deal because you couldn't get any yield on the money anyway. But today, money market accounts are still paying 4.5, 4.75. I haven't seen one over 5 lately, but you have the ability to have your money working for you instead of working for Uncle Sam. But the bottom line is I think a lot of people are missing opportunity to cut taxes. And now's the time to do it.
I think that's a huge message that we'd like people to hear. You shouldn't be looking for, at least I think, you shouldn't be looking forward to that big refund, and say, hey, well, we can plan the family vacation on this. We got a few $1,000s. Like you said, you just gave a tax-free loan to Uncle Sam, and you got to wait for it. It's been a lot more efficient lately. I know they do things automated. You can get a check in the mail or get it deposited pretty quickly into your accounts. But why give them the money? And you don't mind sitting down with somebody in their 40s or 50s and just helping them trim those finer numbers of their retirement planning?
Spike, we will help you. If you need help, we will help you. And here's what I think a lot of people miss the boat. One is they get caught in this back and forth ping pong game, okay? If your advisor works at a bank or is in a retail strip center, all right, they are likely not allowed to give you any type of tax advice, okay? Now listen, I'm not a CPA, guys and gals, okay? Anything I tell you, you should run past your CPA. But let's just look at the concept of doing a Roth IRA conversion where you take money out of your IRA or your 401k for that matter. You move it over to a Roth IRA. When you take that distribution out of your 401k or your IRA, you avoid a 10% early withdrawal penalty, but you still have to pay the tax due on the conversion. Now that money's over in a Roth IRA, it's never taxed again. It's not subject to required mandatory distributions when you turn 73 or 74 or 75, whenever that happens to you. All right. So the bottom line is it's a better opportunity to mitigate tax liability. Well, if you go talk to your accountant about that, they likely won't know a ton about Roth IRA conversions. So they got to tell you to talk to your financial advisor. Well, the financial advisor is not allowed to give you tax advice. Well, I'm sorry, guys. I am a financial advisor. I understand the benefits of doing Roth IRA conversions, and I have no problem telling you that whatsoever. If I think it can benefit you, I'm going to share it with you by all means. So what we try to do is eliminate the ping pong back and forth, and we help. And Spike, another thing that's really important, a lot of firms out there, they want big minimums. So you got to have $1 million to come talk to us. You got to have $500,000 to come talk to us. Hey, good for you guys. Let me tell you what I know that you don't, okay? There's going to be a massive shift in wealth in this country starting now for the next 15 to 20 years. Here's the way it works. The husbands are going to likely precede their spouses in death, okay? Which means the women are going to control the majority of the wealth in this country. And the ladies are going to leave that wealth behind because usually pretty thrifty, by the way, all right? They're going to leave that wealth behind to the younger generations. Those younger generations are going to come into a lot of money, and they're going to need help. And what we like to do is establish relationships with them now. So when that big day comes, they have a relationship with us, and we can help guide them on how to best use that money and be good stewards of that money and take care of the money just like mom and dad or grandma and grandpa would have wanted them to.
We're talking about one of the largest wealth transfers in history happening. There's new numbers out, I think because the markets have been rising. We're thinking it's close to $90 trillion in assets, which is supposed to pass from the baby boomer generation down to the next generation. But Ryan is right. It's going to go somewhere first to the spouses. And I want to make sure that everybody's got a plan, that we transfer this as easily as possible. Just losing out a little bit on taxes, even doing some of our wealth transfer before the end of the year, making sure that you've got all of these things covered up. Got about a minute here on the radio, Ryan. Tell everybody exactly what is a complete review before we pop out to commercial real quick.
Well, what we do at this time of year is tax planning and tax mitigation strategy sessions. To get one, it's free. We don't charge for it, folks. It's 844-944-7555. You can also text the word plan to 21,000. Text plan to 21,000 or call us 844-944-7555. You can also check us out at retirenowhouston.com, retirenowhouston.com, where if you don't believe me, you can go on there and actually calculate your projected retirement tax bill. And folks, some of these tax bills that we see come back on the site are massive. I think taxes will be your biggest expense in your golden years. Let's set your accounts up today to help mitigate those tax liabilities in the future.